So, Craig, catch us up. What's your interpretation of this announcement? Most importantly, December, and how the market reacted.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Yeah. So look, we've been talking about this balance of when the macro data can overwhelm the flows, and then when the flows can overwhelm the macro data. And we saw that the back half of October was a pretty tumultuous time for risk and for risk assets, and markets were, fairly soft and ended, last week, really very close to the lows, and vol was elevated. And then you kind of walk in on Monday, and the war doesn't escalate over the weekend. And so we kick off, this kind of vol selling episode again on Monday, and then on Tuesday, and then into the Fed today. And so it's a dynamic that we kind of, I think, still have to deal with, because the sell vol factor is the biggest thing in the market on any individual day. And so, but we know that, or at least we knew that there was a lot of data this week, both from Treasury and from the Fed. So I'll just kick with the Treasury first. We had the quarterly refunding announcement. The early details on Monday afternoon at 3:00 suggested lower borrowing expectations for the fourth quarter, but still very high expectations for the first quarter of 2024. And so the market kind of got some reprieve, at least the bond market did, that there'd be less supply coming. We talked about in the channel that was likely to come out of bills, but we needed to see this morning's 8:30 release on the bills versus bonds composition in order to make a further determination. And then this morning, when that information came out, it was a positive surprise for risk assets, because Treasury did, in fact, reduce the speed with which they are issuing, increasing the duration issuance. And they've made a much more concerted effort to stick with bills over bonds. And this is something that was a surprise, at least to me, and to some who had been expecting a continued deluge of bond supply. And it's not that we're not getting a lot of bond supply. We are, in fact, getting more bond supply in the first quarter than we would have gotten in the fourth quarter. But there had been an expectation of even stronger supply issuance, and Treasury kind of put that to bed to some degree, and is making a decision to just issue more bills. And so and I had mentioned, I think this is a kind of penny wise, pound foolish decision, as they are going to be shortening the maturities of debt. They're going to be paying up more interest to borrow at the front end. And, but look, I mean, it's, given what we talked about, several times regarding the decision in August and how important that was, I think for bonds selling off, the fact that we didn't get a continued acceleration of supply clearly meant that bonds were going to rally, and that was going to have some risk on impetus for the tape today. So you kind of walk into 2:00 with Powell, and the markets are already kind of feeling, a little bit giddy with regard to how things might go down. Clearly, there were no expectations for a rate hike today. The statement comes out at 2:00. They upgraded their assessment of growth to strong, but they included a line or a word about tighter financial conditions being something that they expect to, slow down the economy, hiring, and inflation later. So I think the initial reaction was, okay, this probably means that, the Fed is going to be done with rate hikes. Mm-hmm. That was the initial reaction. Then as Powell's reading his prepared remarks, he mentions how the labor market really isn't slowing as rapidly as they would like. And to the extent that if we were to see that continue, it would likely necessitate more tightening. So that was the first kind of hawkish thing that he said during his prepared remarks. And then the early round of questioning kind of, to me, suggested further hawkish rhetoric, where he was talking about, really not necessarily being at sufficiently restrictive territory. Again, these comments about the labor market and inflation still being too high. More tightening was the potential for more tightening was there. And the markets did have a sell-off as he was saying that. And so begs the question, did he say something else in the second half of the call, or did the vol algo take over? And look, the truth of the matter is I think it's very hard to tell. And I know, with the markets closing, at the highs here and vol closing at the lows, I think you would say, well, the market's acted, right? The market has acted with its feet. It's pricing out rate cuts forever. And somehow he was dovish. I think the jury's still out. I think that there will be a litany of Fed speakers that come out in the next, starting Friday and into next week that, will talk about an economy that remains stronger than expected, a labor market that is not slowing as rapidly as expected, and that this sequential core inflation data actually really isn't getting better. So, clearly that wasn't the reaction of markets from 305 to 405, but we do have important data the rest of the week. We have payrolls on Friday, which now I think will now take on very big, importance. Not that they're always important, but, clearly another strong labor print here and a wage print and the unit labor cost, we get that tomorrow. If there is more positive momentum on the labor front, the market's going to have to price in a December rate hike greater than what it is currently pricing in, less than 20% chance. Mm-hmm. If that's not how it plays out, then then we will be, looking, I think, probably at the beginning of the year-end rally, because, we'll have been
I'm not there yet, by the way.
Yeah, no, I'm saying if it doesn't, look, I think if we will, by Friday, we will start to be into next week, we'll be starting to push into that window where flows matter more than macro, and the buybacks and the vol suppression and the holding the geopolitical aside for a moment. We'll be getting back into that window where the flows will matter more and there'll be positive flows. And so it'll be harder for macro to overwhelm those flows. So, but look, I think if payrolls are very hot on Friday, the market's going to be sitting here saying, oh shit, excuse my language, but we're going to be raising the Fed's likely to now really be thinking about raising rates in December. So, because right now that's not really being priced in. So there's a lot there, a lot to unpack. The ISM came out this morning as well. It was weak, although manufacturing momentum hasn't been, very strong for a while. We get services PMI on Friday as well. Clearly that there's been strong momentum in the services part of the economy. I think there is a, belief in an imminent recession always. And when you watch TV and you listen to Bloomberg and CNBC, you listen to Druckenmiller talking about a recession coming, and Jeff Gundlach talking about a recession coming.
And his massive 2-year bull bet in yield.
Yeah, look, I think it is in the narrative, and we've been waiting for a long time, and it clearly seems to be something that the Fed hears as well. But yet, when the real data comes out, it continues to push out the day of reckoning. Yeah. And in the meantime, we are not durably getting closer to returning inflation to 2%. So, and the more you get days and reactions like we got today, which is, a significant easing in financial conditions, the more likely that you're going to get inflation expectations moving back higher again. And then we just kind of start this whole saga over again. And Powell was asked about the potential for, rate hikes in, next year if we don't get them. And I was listening afterwards to Dudley, who, said, look, he said, if the Fed goes on pause for 6 months, which effectively would be, July through, and then of next year into next year, and then realizes the mistake and that inflation expectations are moving back up again, one rate hike is not going to be enough, right? They're going to have to do more. So I think, again, a lot to unpack there. The jury's still out, but I'm not sold yet that today's reaction is the be all end all of market reactions. Obviously, Apple's tomorrow after the close as well. So still a lot to go on this week. But yeah, look, from my perspective, disappointed in that Treasury, didn't do what I thought it was going to do, and didn't do what they were supposed to do. And so, is there a political angle there? What is that? Uncertain, really uncertain. There is a short-term decision here by the Treasury to, not issue more at the long end despite low term premiums and an inverted yield curve. And frankly, I think it's a very foolish decision, but maybe Treasury really does believe in a recession coming imminently, although that's not what they said. But to me, it seems like a mistake, and we'll see how the market reacts to it in the coming days.
The full episode is available to all Edge paid subscribers. Visit www.laductrading.com/edge for more information.